When it comes to investing, we all strive to buy low and sell high. Successful investing is all about patience, especially when it comes to dividend investing. You must allow the process of compounding dividends to take over and do its work in your favor. This is where you use the dividends that you have received to buy back more shares. So then that next year, when the company increases their dividend, they're going to be paying out a higher dividend, and you have more shares equating to even more dividend income. And you can see how this process continues to gain steam and the compounding works in your favor. In the beginning, dividend payouts can be very small, but in the end, they could be paying your phone bill, utility bill, or even your mortgage bill. Today, we are going to be talking about 3 high-quality dividend stocks that are trading at a cheap valuation, giving us the opportunity to buy low. Hey everyone, Mark here, back for another video, and this week I have a very exciting announcement. Today, I am launching a brand new Discord community group that has over 20 teachers that are well versed in all of these different areas of passive income. This entire community is focused on passive income, and the name of the community is the CASHFLOW University. Down in the description below, I will put a special link to this Discord group. We have channels related to dividend stocks, index funds and ETFs, short-term property rentals, Airbnb rentals, cryptocurrencies, and mining crypto. We have options trading, cash secured puts, or even covered calls. We will be placing all of our trades there and also using this platform to educate those and answering any and all questions. We'll be doing weekly webinars across a whole array of different topics focused entirely on passive income. So if you are interested in a community focused entirely on building your passive income stream, then definitely check out CASHFLOW University. I will leave a link down in the description below. With that being said, let's take a look at these 3 high-quality dividend stocks that are trading at very cheap valuations. The first dividend stock that we're going to look at today is the home improvement giant Home Depot, stock ticker HD. Home Depot has a market cap of $306 billion, making it the largest home improvement retailer on the market today. During the pandemic, while many of us, at least here in the US, were stuck in our homes, many of those home improvement projects that we had been putting off were all brought forward, and shares of Home Depot took off during those early pandemic times. From those pandemic lows in March 2020 to the highs of Home Depot seen in December of 2021, shares of HD moved higher by over 160%. Since then, however, shares are down over 30% and looking quite attractive. Before we take a look at valuation, let's take a quick look at how the company has been operating. Looking here at these charts, you can see how revenues, operating income, and EPS have steadily been rising. Over the past 12 months, revenues have reached $155 billion. Net operating income has reached $24 billion, and EPS is now at $16.27. All of this has helped fuel a growing dividend, making Home Depot a great dividend growth stock in itself. The current dividend sits at $7.60 per year, which equates to a dividend yield of roughly 2.5%, backed by a very safe payout ratio in the low 40% range. Over the past 5 years, Home Depot has increased their dividend at an average annual rate of 17%. This pullback has allowed investors a great opportunity at this blue chip dividend growth stock. In the near term, there are plenty of headwinds to discuss for Home Depot. Some of those home improvements projects that we saw pulled forward, those are going to slow. We're also seeing the housing sector slow mightily as prices have come down nearly 20%, putting housing in nearly a recession in itself. Rising interest rates are going to continue as we see the Federal Reserve continuing to fight high inflation. On a valuation basis, Home Depot is currently trading at a price-to-earnings ratio of 17.2. Bearing the brief moments immediately following the pandemic start, This is a great and one of the cheapest opportunities that we have seen in Home Depot. On a forward-looking basis, analysts are expecting 2023 earnings per share to be roughly $17.38. Using those estimates, that equates Home Depot to having a forward earnings multiple of just 16 times. Compare that to their 5-year average of 22.8 times. Again, understand those short-term headwinds with housing and rising interest rates, but do understand that this is a high-quality company and it is trading at a very cheap valuation for the long term. The second blue chip dividend stock that we're going to look at today is FedEx Corporation, stock ticker FDX. FedEx currently has a market cap of $54 billion, making it the second largest express transporter behind UPS. Shares of FedEx right now are down roughly 25%, having the company in its own bear market currently. And as we are seeing, this is another high quality company, a proven company that is just out of favor right now. Some of the concerns right now around FedEx relate to rising labor costs that they've seen. They've also seen other labor issues with the work environment and rising fuel costs. However, these do not seem to be permanent headwinds. And this is something and a keys that I look for when looking for cheap valuations right now. Are they running into permanent issues, headwinds, or are these things that are going to blow over and be fixed over the long term, making this a great opportunity to get into a blue chip company? The company recently had an investor day where they laid out plans through the year 2025 in which they are expecting EPS growth between 14 and 19% over that time span. So these next few years are going to be huge for this management team because over the years there's been plenty of misfires with certain acquisitions and use of capital. This is a very capital intensive company and a very low margin business where there's not a ton of room for error. For years it was much of a three-headed monster in this delivery space with FedEx, UPS, and DHL. However, over the years the US Postal Service has gotten more involved, although they haven't really figured out how to move a profit. But now there's another giant elephant in the room, and that is Amazon, always seeming to find a way to get involved. On the year, shares of FedEx are down 20%. And looking here at the charts, you can see how revenues and operating income and EPS have steadily been rising. Over the past 12 months, revenues have reached $93.5 billion, moving higher over the past decade. Net operating income has reached $6.5 billion, and EPS is currently at $14.30. All of this has helped fuel a growing dividend, which currently sits at $4.60, equating to a dividend yield of roughly 2.2%, with a safe payout ratio of 20%. Over the past 5 years, that dividend has grown at an average annual rate of 16%. Currently, shares of FDX are trading at a price-to-earnings ratio of 10.3 times, and on a forward-looking basis, using the analyst expectations for 2023 of $22.55, that equates to a forward price-to-earnings of only 9 times. And over the past 5 years, shares of FedEx have traded closer to 13.5 times. Similar to what we saw with Home Depot, FedEx also has some short-term headwinds. However, we are also seeing the expansion of e-commerce that is only going to continue to grow and will continue to fuel growth for companies like FedEx, making this a great time and a great valuation to look more deeply at a company like FedEx. The third dividend stock that we're going to look at today that is trading at a very cheap valuation. You will not believe the valuation that I'm talking about until I tell you. But that company is Ally Financial. Stock ticker ALLY. Ally Financial has a market cap of $10 billion. The company operates in 4 different segments. They have their automotive financing, they have their insurance segment, they have their corporate financing, and they also have their mortgage financing segment. Many of you may not be as familiar with a company like Ally Financial, until recently that is, when a small little company called Berkshire Hathaway, which is led by a little known investor like Warren Buffett, invested heavily in Ally Financial, recently adding over 20 million shares bringing their total to 30 million shares valued at over $1 billion. Now, it's still a very small piece of the Berkshire Hathaway portfolio as a whole, but getting the eyes of Warren Buffett and his team is something to take note of. On the year, shares of Ally Financial are down 34%. But when we look at the company in recent years, there's been a lot to like, and they have really benefited from this chip shortage that we have seen, which has driven the price of cars and used cars even much higher. This has increased their retail car loan business, which in the second quarter was up to roughly $9.5 billion. Now, there are some concerns, as we are already seeing it, on the price of used cars coming down. And this could be a negative that investors are looking at for Ally Financial. But is some of this already priced in? You might think so when we look at this valuation. When you look at the management team for Ally Financial, this is well known to them because in 2023, they are already modeling that used car prices are coming down 30%. So they are already baking this in. And Warren Buffett and his team completely understand that. In fact, he is very well versed in the automotive sector, having invested in General Motors for decades. But this is another company that fits perfectly into that Berkshire Hathaway model. You're looking at a company that is in insurance. We know Warren Buffett loves insurance. They're trading at a very, very cheap valuation compared to their historical standards, and they pay a very solid dividend. The company currently pays a dividend yield of 3.5%. That is backed by a low payout ratio below 20%, making that dividend plenty safe. And over the past 5 years, the company has increased the dividend at an average annual rate of 26%. Now let's get into valuation and really get ready for these numbers because these are real, actual numbers. I am not going to be joking about these, so definitely listen up. All right, in terms of valuation, and you're going to think I'm lying, but shares of Ally Financial trade at just 4 times earnings. Yes, 4. You heard correctly. Over the past 5 years, now the stock is not a high multiple stock by any means, but over the past 5 years, the company has traded at an average earnings multiple closer to 9 times. So we are talking about over a 50% discount to average, just average multiple, making it a very intriguing time to look at adding shares of Ally Financial. You're going to get insurance exposure. You're going to get financial exposure in this digital bank company. And you're also going to be following the great Warren Buffett and his team into shares of Ally Financial. High dividend, growing dividend. All right, folks, there you have it. 3 high quality companies trading at very cheap valuations. The first 2, Home Depot and FedEx, more of these blue chip type, trading at cheap valuations. Ally Financial, insurance may not be as well known, but typically trades at a lower multiple, but not at a multiple of 4 times. So definitely take a look at all 3 of these dividend stocks. Let me know down in the comments section below if you own any of these 3 stocks and what you think of them. Also, if you could do me a huge favor and click that like button down below, that is huge for the growth of this channel moving forward. And come join us at the Discord group. CASHFLOW University kicks off today, and I can't wait to see you there. Check out the link down in the description below. And with that being said, we will see you in the next video. Take care.